Hi everybody, thanks for joining us for our next Facebook Live session. I'm Susanna with ATBS, and today we're going to be talking about the Tax Cuts and Jobs Act and how that affected owner-operators on their 2018 taxes. And to join us today for to talk about that data, I have Michael Schneider here, who's our Manager of Tax Services, and of course Todd Amon, who is our President and CEO. So thank you for joining us, both of you guys.
Hi, Susanna.
So we're going to dive right into some of the data that we've collected as part of doing tax returns for our clients this year. And based on that data, it looks like the average adjusted gross income for owner-operators rose from about $43,000 in 2017 to $52,000 in 2018. So can you guys explain to us what might have caused that increase?
Sure. Yeah. So first, we should probably explain what adjusted gross income is. You might hear it as AGI, and what that is your total earnings and your total losses on your tax return before your standard deduction, itemized deduction, or your various tax credits that you might receive for your kids or things like that. So really, it's a good indicator of how well you did that year. So an increase in AGI would mean that you either earned more income or managed your expenses better. Or both. So that would cause an increase to your AGI.
Okay, great. And that's good news to hear that that was a trend with our clients.
You know, one thing I'd just jump in and say too, because if you watch our Facebook Lives, you would have seen one earlier in the year that talked about owner-operators income increasing greatly this year from $60,000 to $65,000. And so it can get confusing when we say owner-operators made $65,000 in 2017, but then you hear this AGI number where we're talking about $52,000, and really the difference in those, a significant piece of that difference is a per diem deduction. But you know, AGI, you're trying to minimize your income from tax purposes, so you might get some more deductions in there as opposed to when we just talk about net income for owner-operators of $65,000. So I just want to make sure if people are watching past Facebook Lives, they don't get confused between us talking about $65,000 net income back in April and now we're talking about $53,000. So just that clarification.
Great, yeah, thank you for doing that. So total tax liability also increased, and it went up from $8,200 in 2017 and then moved up to $9,200 in 2018. So even though the liability increased, why do we still consider that a good thing?
Sure, and that's a great question because on the surface it does look like a negative thing. Hey, I paid more in tax, doesn't seem like good news. But that combined with the adjusted gross income increase that we just talked about makes sense. When you make more money in the U.S. tax system, you pay more in taxes. So with adjusted gross income increasing, that means there's going to be a tax liability increase also. So that's to be expected. So we'll talk about some other things that were positive, but tax liability didn't increase that much, considering the increase in adjusted gross income.
Right. So some more good news is that the overall effective tax rate actually went down from 19.1% to 17.8%. So then how is that calculated, and can you explain what that means?
Sure, yeah. So essentially the effective tax rate, or their overall effective tax rate, is really after all of your deductions and all of your tax brackets have been calculated and the tax return is entirely done. You get that number by dividing your total tax by your total taxable income. Some may be familiar with the kind of progressive tax system that the U.S. has. You start around 10%, increase to 12%, then increase to 24%. I think there's a 15% in there. Oh no, I'm sorry, that's the old rate. It goes 10, 12, 22. So essentially for a single filer, the first 10,000 is going to be taxed at 10%. The next 20,000 is going to be taxed at 12%. And then anything over 30,000 is going to be taxed at 22%. That's all the way up to 84,000. So most folks are going to fall in that 10, 12, or 22% bracket. But not all of your income is taxed at the bracket you're in. It's a progressive system. So the first 10,000 you pay 10%, like I said. So your overall effective tax rate is a combination of all of that tax and what you actually paid, more as an average, if you want to think about it that way.
Okay, great.
One thing I think that we can help for the folks that watch this is we get a lot of new owner-operators that watch and read the stuff that we put out. And you know, when you go from company driver to being an owner-operator and you need to start paying quarterly taxes, they have no idea what to pay in quarterly taxes or what to set aside. And oftentimes we'll tell a driver, put aside 20% of your net paycheck or maybe 25% of your net paycheck. If you use these numbers, exactly, you'd be at 17.8% last year. But remember, that's an average. So if you're making a bit more money than the average, if you're making 70 or 80,000, you might be more like 22%. If you're making 40,000, you might only be like 12%. So just a good guide for those of you that don't know how much to set aside for estimated taxes. Somewhere between 20 to 25% of your net paycheck is a pretty good guide, but there's a lot that goes into that. So just maybe keep that in mind. And just one other thing about estimated taxes, ATBS has a really sophisticated system of telling you exactly what you owe for estimated taxes. And we try to get really close by the end of the year, but again, just to give some folks some guidance on estimated taxes.
Great. What were some of the specific reasons why that effective tax rate went down for so many of our clients last year?
Sure. So obviously the reasons we talked about already, there's the lower overall effective tax rate. Even though AGI increased, your overall effective tax rate was less. So you paid less in taxes. Another way to think about it is you would have paid more if the Tax Cuts and Jobs Act hadn't been passed. So that's another way to think about it. But another reason is the Tax Cuts and Jobs Act introduced the Qualified Business Income Deduction, the QBI. And for self-employed individuals, what that means is they got to deduct the lesser of 20% of their taxable income or 20% of their net profit. Just as a brand new deduction, that's something the IRS introduced to help self-employed individuals. So if you made $10,000 as a self-employed business, you got to deduct $2,000 of that for no other reason than the Tax Cuts and Jobs Act. So that was introduced, that definitely helped. Another reason taxes were lower this year was because tax rates were cut about 3% on average on every bracket except for the 10% bracket. So the 10% bracket stayed the same, but like I misspoke earlier, it used to be in 2017 there was a 15% bracket. That bracket's now 12%.
Okay.
And every bracket was affected about 3%.
Okay. And you talked about the qualified business income deduction. How many of our clients took advantage of that, and then what was kind of the overall effect on their taxes from it?
So a total of 68% of owner-operators were able to use that qualified business income deduction. So those folks that didn't, really what that means is that they didn't have profit or taxable income. So they were actually already at zero. So they didn't have to use that deduction.
Okay. And then what was the ultimate tax savings that resulted from that?
Yeah, so the qualified business income deduction resulted in about an average deduction of $6,200. And if we apply that effective tax rate of 17% or so, that came out to $1,100 in actual tax dollar savings.
Okay, great. So that was a pretty big deal for owner operators.
Yeah, absolutely. $1,000 in your pocket that you didn't have last year.
Great. Next question. In 2017, 71% of our clients used the standard deduction, and in 2018, 94% used that standard deduction, which we were expecting to see.
Yeah.
Can you explain why that was better for most clients to use?
Yeah, so that's a huge increase, and the standard deduction is always compared to the itemized deduction. So those are that familiar, you use the one that benefits you the most. Itemized deductions are things like your home mortgage interest, your property taxes, your charity, sometimes medical expenses, things like that. The standard deduction is just a flat rate that the IRS allows every single filer, every married filer to claim. The reason for that increase is because, like I said before, you pick the one that benefits you the most, and the Tax Cuts and Jobs Act almost doubled the standard deduction for all filers. So last year, 2017, was single filer was about $6,350 was the standard deduction. Married was $12,700. This year, with the Tax Cuts and Jobs Act, single filers were at a total of $12,000 and married filers at $24,000. So that's a big jump, and it's hard for most folks, as we're seeing here, 94% of people use that standard deduction amount. It's hard for most folks to find enough itemized deductions to beat that number.
Right.
Especially if you're married, $24,000 that's pretty much the one you're going to take if you're looking at which one to use. So that's actually a good thing. People got more of a deduction on their tax return overall.
Great.
I think something that's really important to understand is our goal, many times, especially in doing something like this, is just to try and demystify and simplify all the misinformation that's out there about taxes and the tax code and Tax Cuts and Jobs Act and the new stuff that you read. And so I remember the days of hearing about the Trump tax cuts, and I remember hearing Trump himself say, every American's gonna be able to file their taxes on a postcard. I'm gonna simplify the tax code. And at the end of the day, Michael got more pages like this. I think there were 1,100 more pages added to the tax code from the Tax Cuts and Jobs Act. And so you can't add 1,100 pages and have things get more simple. But really, truly, this is the area for many Americans that life got simpler. When you increase that standard deduction double, now most Americans, don't need to itemize or detail their home mortgage and their IRA and all those things. They can literally file a postcard, which is a great thing, right, for the average American. Unfortunately, for an owner-operator that has a complicated business with a lot of expenses, your tax return is still, fairly complicated and takes time and energy and effort to put together. So even though you no longer probably itemize on Schedule A, which is a good thing, there's still a lot of complexity to the average owner-operator's tax return.
Absolutely, and that was kind of by design. I mean, that's part of this was to make taxes a little more simple, but like you said, they added 1,100 pages. So the simplicity they added also added complexity.
That's true.
Let's talk a little bit about the depreciation deduction. So that deduction increased from about $17,000 last year or the year before to $21,000 last year. What do you think caused that significant increase?
Yeah, so this is another really cool thing that the Tax Cuts and Jobs Act added. The increase in depreciation essentially is more taxpayers taking advantage of that through used property is my analysis of it. Under the old rules in 2017, you were only allowed to use 100% depreciation on brand new assets. The Tax Cuts and Jobs Act introduced that same law for both used and new assets. So now if you buy a used truck, you can still have that option of 100% expensing it in the first year if you make that choice. So I just see people taking advantage of that if that is to their benefit.
Great.
Yeah, and it's important for us to remember because we're now, midway through 2019 and we're talking about 2018 tax returns, which are a year old. So that continues forward. So if you're thinking about buying a new truck or buying a trailer, a new used truck or new used trailer or any capital asset, an APU, a computer, just remember you can expense that 100% in the year that you buy it. But that's also really complicated, and it's something you need to work with your CPA through because it may not be to your advantage to take all that depreciation because then you may chew up some of that, qualified business income deduction and those things. So you got to kind of run some different scenarios to make sure you're doing the right thing. But in the end, it gives us a lot more flexibility to minimize your taxes.
Great. So far we've talked about all of the positive impact that the Tax Cuts and Jobs Act had on taxes last year. Were there any negatives that owner-operators saw?
Yeah, I did see an increase in the excess advanced premium tax credit. That's a really long name for health insurance penalty. What essentially happens is if you go to the federal government or the state government to buy your insurance and you accept a subsidy from them for the government to pay for a part of your health insurance, that's all based on the amount of income that you earn. So we don't know that, the health insurance company doesn't know that until the end of the year when the tax return is filed. So the subsidy they gave you may have been too great or too little, and that's what causes a penalty to have to be repaid. If you took too much of a credit during the year and then you go to file your return and they realize that you didn't make the income that they thought you were going to make and you owe some of that back. It's somewhat complicated to explain in this format, but essentially there's a 50% increase in those subsidies having to be repaid. So what that tells me is people were probably underestimating their income when they reported it to the health insurance company, saying you earn X when the return is filed, and like we talked about AGI increase, you did better in 2018 than you thought you were going to do. So all of a sudden you don't qualify for that whole subsidy and you have to pay some of it back. That increase was actually from about $1,600 to about $2,700, almost $2,800. So about a 50% increase in that penalty. So a couple of warnings is just know how you're doing in the year. Report the accurate or as accurate as you can information to the subsidy health insurance companies if you're using that for your health insurance. If you're using your employer or your spouse's employer or something like that, you don't have to worry about that. This is only if you go through the government exchange and receive a subsidy for your insurance. So that's probably the biggest feedback I could give folks who experience that penalty is really be accurate in your reporting to the health insurance company. And if things change, I mean, we're in the middle of the year right now. If things change and you've done a lot better than you remember reporting, just call them back up and let them know. That'll minimize that penalty and help you out.
And then, but that penalty will go away at the end of this year, or?
That's an important distinction. So there are two types of penalties for health insurance. One was government mandated insurance. You were just required to have insurance. If you don't have insurance in 2019, you will not be penalized for not having insurance. That penalty is gone. However, if you use the subsidy program that I was just talking about and you use insurance through the government and receive a subsidy, you could still be subject to that subsidy change. If you took too much of that subsidy, you'd have to pay it back.
Okay.
So that's a little confusing, but the short end of it, you're not required to have insurance and you won't be penalized for not having insurance. If you get money from the government, you just want to be accurate in that number that you're receiving from them.
Perfect. Thanks for clarifying that. Let's see. And then, so this is probably a really good question for Todd. What advice or suggestions would you give to owner-operators who maybe didn't have a positive impact on their taxes last year?
Well, the easy answer is to use ATBS, but that's kind of a flip, funny answer. And really what I'd say is a couple of things. Taxes are confusing. Truck driver taxes are especially confusing. And I think one of the most common confusing points that we deal with and explain to people is around per diem. And so I would say we'll have a lot of company drivers that will watch this Facebook Live session. And I would say company drivers, as a general rule, got hurt by the Tax Cuts and Jobs Act. It essentially eliminated the per diem deduction as an itemized deduction for company drivers. I don't think that was the intended case, because company drivers, as far as average earners in America, they're not high income people. And so the government didn't intend for you to pay more in taxes. It was just kind of one of those things that got overlooked when they created the 1,100 pages. Many companies that company drivers drive for kind of mitigated that by creating per diem pay programs for their company drivers. That's really too complicated to go into here, but I would say if you're a company driver, you got hurt by per diem pay being eliminated, our industry is lobbying very strongly and very hard, and I'm optimistic within the next year we may get that per diem pay deduction reinstated for company drivers. If it doesn't happen until then, look for a company to drive for that does have per diem pay. That'll make sure you avail yourself to that deduction. From an owner-operator perspective, I would say that there were many, many positive influences in your taxes, as Mike just went through a lot of those, from depreciation to qualified business income deduction to the standard deduction increasing. And so if you feel like you didn't benefit from the Tax Cuts and Jobs Act, your accountant, your CPA, whoever's doing your tax return may have missed some of those things. And at ATBS, we'd love to have you for a customer, but give us a call if you feel like you didn't get full advantage. We'd be happy to kind of talk through some of those points with you and see if we can make sense of it for you. Because truly, at the end of the day, what Michael said is the effective tax rate for the average client went from 19% to 17%. Even though the overall gross tax payment went up, it's because drivers made a lot more money last year. So just make sure you're getting every deduction you can. Nobody wants to overpay the IRS. We all have to pay the IRS. That's the world we live in. That's how we pay for roads and schools and all the things that we have, but we don't want you to overpay the IRS. So give us a yell and let us help you out.
Great. Well, thank you for all this information, guys. It's been really helpful. If you out there in the audience have any questions for us, feel free to post those questions on Facebook or give us a call. Check out our website at atbs.com. And until then, drive safely and let us know if there's anything we can do to help you. Thanks, everybody.
Thanks.
Drive safe.